See there? And welcome to IET Central London. My name is David Tabor. I'm one of the volunteers that we put on events like this on the Wednesday evening every month, and we have some at Friday lunchtimes. So please, at the end of this, we will show you a list of the upcoming events. So please do register and come along to some more. Just to let you know, a bit of housekeeping, there's no fire alarm test planned. So if it does go off, please make your way out of the building following the standard green signs and get together under Waterloo Bridge, on the pavement preferably, rather than the river, and we'll go from there. But hopefully that doesn't happen. Right, well, tonight it's actually quite special because our speaker, Ben-Ari, gave us a talk here 6 years ago on blockchain when it was still pretty new, really, and it was very well attended and lots of people had lots of things they wanted to find out about it. So we thought it'd be a great idea to get Adi back to give us an update on what's been happening in the blockchain space, and I think a lot has been going on, some of which you may have read in the press. And then I'm sure there's other stuff you haven't. So a quick introduction. I mean, Adi's had many, many years of experience in this. He set up the company Applied Blockchain back in 2015, was it? Yeah. And they've done an awful lot of real-world applications, tracking. Are you probably going to go through some of these things?
I'll go.
Yeah. But there are a lot of real-world applications, which I think is what we all really are interested in. So the intention is that Adi will give you the talk, and then we'll have, well, he may request questions and things as we go through. Otherwise, we'll have a Q&A session, and then finish off for more networking outside. Anyway, could you please welcome Adi Ben-Ari?
Thank you very much, David. Right, so before I start, I guess I'm going to cover different aspects of blockchain, and in particular why we need a certain type of data privacy. It's a big topic. Blockchain in general, I think, is a big topic, and different people have interest in it for different reasons. So I think given that this is probably quite a varied audience, I'm sort of happy to take questions all the way through. Feel free to interrupt. If I feel that you're taking me completely off topic, I'll let you know. But otherwise, I'll try and address questions and sort of make it interactive. Okay, so as David said, my name is Adi Ben-Ari. I founded a company called Applied Blockchain in 2015. My background is technical, so I was a software developer. I led development teams, and I worked as an architect, as a software architect. At large companies, 15 years in telecoms, 5 years in insurance and banking. My last role before starting the company was at Lloyd's Banking Group. And around 2015, a former university roommate of mine was trading Bitcoins. Said to me, "You've got to check this out." And being more technically minded, I ignored the trading aspect. I didn't buy lots of them. I just looked at the tech, fell in love. It completely blew my mind. I'm going to share with you really some of what I saw in the technology and why I've spent the next 10 years building up the company and building lots of solutions for different companies that we've worked with. It's been a 10-year journey. The team we have now is around 70 people. We're about 20 in the UK, about 30 or 40 in Portugal. We have a team in Porto, and the rest spread across other countries in Europe primarily. We've delivered, I think we've worked with about 150 different projects, and that's more or less the number of clients as well. Our biggest client is Shell Trading. We have a very large project with them. I'll talk about that later. And this is a list of some of the other companies we've worked with. David said that blockchain, when I was presenting it 6 years ago, was still quite early. I think it's still very early. And a lot of the projects that we've worked on, a lot of work that you'll see here is experimental. But I'll take you through where I think this is going as well, and why I think it's interesting. So list of clients, I'll talk through the projects a bit later. So I'll go straight to the hype. What we've seen in the last year is a change in the US administration, and with that, a change in attitude towards blockchain technology in general and digital assets in particular. And what's happened in the US is that the regulator has switched from really trying to shut down anything related to blockchain to beginning to regulate it and actually moving quite quickly. So around 6 months ago, we got a regulation in place called the Genius Act. And the Genius Act enables tokens on a blockchain to be backed by US dollar debt. And for those tokens to represent US dollars backed by US government debt, very, very specifically regulated and specified in that act. What that really does is it opens up the ability for regulated financial institutions in the US to interact with this technology in the way that they couldn't before. So a large bank in the US, for example, can now interact with a blockchain, take payments on a blockchain, and actually use the technology in a way that it couldn't before. So this has really opened things up in a big way. We've got really a whole wave of companies, large players, starting to act in this space. So a few examples of what's happened in the last 6 to 12 months. So there's a company called Circle, which issues one of these US dollar stable coins. And they IPO'd this year. I think it was on the NASDAQ, and they had, I think it was one of, if not the most successful IPO of the year. So a lot of investors wanting to get into the space and into that niche in particular through Circle. Stripe, which is, as most of you probably know, one of the biggest players in payments, has made a number of acquisitions in the space, including acquiring a company called Bridge, which is what we call an on-off ramp for people to take fiat money from their fiat bank accounts and acquire these US dollar or other currency tokens. So Bridge provides that service. Stripe has acquired them. They acquired a number of other companies as well. And now we've got the tier one banks, so banks like Citi and JP Morgan, really mobilizing quite large teams, 100 to 250 engineers, and building more and more infrastructure in the space. So the change in the US administration has really brought with it a lot of interest, a lot of activity in the space. And so that's more the banks and payments players. We've also got the largest asset manager, BlackRock, and the CEO, Larry Fink, very, very bullish on blockchain technology and claiming interview after interview that all of the assets in the world will be tokenized at some point, and so will appear on the blockchain. Coming from one of the most traditional and largest institutions, this is it's obviously, I think we have to take note. And in terms of numbers, this is what we're looking at in terms of his vision becoming a reality, which is a large number, a large portion of assets in the world, in particular financial assets, being represented in tokenized form on a blockchain ledger. Okay, so this is some of the background. I guess it's fair to say a lot of what I'm representing here maybe goes against some of really how Bitcoin and some of the technology started. It was kind of a movement to create an alternative financial infrastructure and an alternative currency or set of currencies. And now what you can see is all the regulated players and the existing financial institutions jumping in because they can see the efficiency of the technology. And that's what I'll focus on in a minute. So just to go through some of the fundamentals about blockchain and how blockchain works, I won't spend too long on this, but I see this, even with people who spend a lot of time in the space, they kind of sometimes miss some of this. So I think it's really important to get the fundamentals because then you can look at the different platforms and solutions that are out there in a different way. So first of all, the value of blockchain from my perspective, and this is from an engineering perspective, is group security. Right? So what you have a ledger, which is essentially a database, and it's being looked after by a group instead of being looked after by one party. Right? Now, what does that really mean? Does something that's looked after a group, is that more secure than something that's looked after one party? It depends, right? Depends who that one party is, depending what measures they have in place, depending who the group are, depending how they operate together. So are they likely to collude to defraud everybody? If they are, then they're not really adding much security. It's probably the other way around. So what blockchain does, and in particular public blockchains, if you look at Bitcoin, blockchains like Bitcoin and Ethereum, is they have a set of cryptographic, there's a cryptographic protocol, and with it an economic model that allows anyone to be part of that group and disincentivizes them from colluding to undermine the security of the ledger. Okay, that was really the genius of Bitcoin. It's a model where if you join, you get rewarded, and you have a cost associated with being part of this network. That means that if you were to try to override the network in some way, it wouldn't be economically viable. Right? You're disincentivized from doing it. And so that's really the fundamental core value of this technology, is that it provides extra security through the network. Okay? I can trust this random open group of validators, as we call them, more than I can trust one institution. Okay? And the reason is because I have all these technical and cryptographic and economic guarantees, whereas if it's one institution, it could be hacked, it depends on its processes, depends on the people, there could be some rogue players inside, and so on. So you can look at this, and also depending maybe on your political views and view of the world, you might see one as more secure than the other, right? But that's the fundamental value of blockchain. So a typical blockchain network is going to involve a number of these nodes. These nodes, we also call them validators. In what we call a public blockchain, I'd say a regular blockchain, we have the nodes that are each holding a database of records. The primary thing that those records are holding is records of ownership, right? Who owns what? And the who is defined by these different users who hold wallets. Those wallets contain private keys. Those private keys are the way that they identify themselves to the network. So if in these records I own some assets, those assets are registered against my private key. The way I claim those assets is by signing with my private key. Okay? So that's the fundamental kind of security model, if you like. The idea is that all the nodes are identical. They all contain the entire ledger. Okay? And that way we're not dependent on any one party. And then they have a consensus protocol where they agree and they get updated, and they agree again on the updates, and so on. The other thing that they're able to do, and this is what Ethereum brought beyond Bitcoin, is we're able to run what are called smart contracts. Smart contracts is basically business logic that we can layer on top of these records of ownership or assets. So if I own something and I want to transfer it to someone else, but in the transfer I want lots of different checks and things to happen, I can create a smart contract, and the assets will move through that smart contract, which means there'll be code that's executed, and I have guarantees about the execution of that code because it runs on all the different nodes. So in the same way as we have identical copies of the ledger everywhere, we also have identical copies of the code. The code is executed everywhere, individually by all of these validators. They all compare their outcome, and if they all agree, then the result is put onto the ledger, and we move on. And what this gives us is a guarantee of the execution that's going to happen on the network. So if I've got an asset and I send it into one of these smart contracts which has some code, I've got a guarantee from the network, everybody that's running this, they're going to execute the same thing, and the outcome is going to be valid. There's nothing else that can happen here, right? Unless the whole network is completely undermined, and as I mentioned at the beginning, it's very, very difficult to do. Okay? The interesting thing here, if you look at the theory, how's it played out in practice? But if you look at Bitcoin and Ethereum, they've been around, Bitcoin, I forget how long it is now, it must be about 15 years. Ethereum, around 10 years. And essentially the ledgers themselves have never been compromised. So all the hacks that you hear about, what's compromised is those wallets, those keys. Right? You've got exchanges that hold keys for people, you've got people who've lost their wallets, and lots of other things that can go wrong. But the ledgers themselves have stayed intact. And I think that's super interesting because these nodes, they run the blockchain software, they all run the same software, but they have no other security on them apart from the software itself, apart from the protocol itself. So if you look at a bank, banks will typically spend, a big bank, even in the UK, will spend £1 billion a year on its cyber security. These things are running without a firewall, right? There's nothing guarding them, right? It's just the protocol itself, right? The Bitcoin protocol or the Ethereum protocol running, yet 10 or 15 years out in the wild, holding billions and billions of dollars worth of value, and they haven't been compromised. Right? And that tells you something about the elegant, pure secure mechanisms that they're engineered with. Right? All the actors in the world who are trying to have a go at it with no other protection have not yet been able to get through them. Yep.
Yeah, so, but is there actually a possibility of them being compromised? If so,
Is there a possibility?
yeah, so how would that sort of play out?
Yep.
Smart contracts, just to add to that,
Yeah.
smart contracts can be compromised, but that's
Correct.
not the actual
Correct. So I'm talking about the ledger itself and the blockchain software, the protocol. Smart contracts you can think of as apps, right? They're like apps that we run on our smartphone. So if the blockchain protocol is like the iOS operating system or Android. People can deploy apps on top. Those apps have, depending on the developers behind them, they may be more or less secure, right? And so those obviously have had issues. But the protocol itself, they're effectively not had any issues. The way a blockchain is compromised, or these public blockchains, the way they can be compromised. So the way they agree is through a majority consensus. If you can run the majority of the nodes, and by running them you can force some kind of rogue agreement, because you now control the majority, then you could effectively undermine the security of the ledger, right? And you can move assets that are not yours. The thing is, you'd have to run more than half of the, yes, you'd run more than half the network. Ethereum now, I think, has hundreds of thousands of nodes. The Ethereum and Bitcoin have different mechanisms now. Bitcoin has proof of work, which costs electricity, artificially pumps up the cost of electricity to run it. And that means that to run lots of nodes, you're going to have to pay a very big electricity bill, which isn't going to be worth it. That's how the economics are taken care of. Yeah. But yeah.
There was some news which I noticed this morning.
Yeah.
There was somebody in China complaining that somebody had transferred a lot of bitcoins or assets.
Yeah.
From an account because they were being accused of actually stealing money. So
Yeah.
I think it involves the U.S. Secret Services and the UK Secret Services.
Yeah.
I saw it this morning and I thought to myself,
Yeah, it was just the crypto queen
yeah.
thing. Yeah. I mean,
How could that happen? Did they go after the wallet?
no, I mean, somebody convinced lots of people to convert their money into tokens and send those tokens to this address, to this person's wallet, and this person collected those funds and kept them, right? So the system worked, right? It wasn't that anything was stolen, and people willingly transferred their funds, but they were defrauded because they were made promises about what's going to happen to this money, how it's going to multiply and grow. That's fraud.
But
Right?
they managed, the Secret Services managed to get the money.
They did, and that probably comes to the core of this lecture as well, is that this is all public, right? And because these networks are open, I said anyone can host a node. So I could download an Ethereum node, probably still run it on my laptop, and connect to the network, and I would get the entire ledger of transactions. And that means that everybody can see the transactions, and that, including the authorities. And the authorities have tools. I think it was one of you two who worked at Elliptic. Yeah. So I mean, there were companies out there who specialize in analytics and attempting to understand who's behind the different accounts and addresses, and looking for patterns on the blockchain, off the blockchain, and so on. So they obviously did a great job here.
Yeah, so the wallet was compromised in that, in this morning's case.
Right. Okay. Yeah. So that's a bit on the fundamentals. Now, probably go back here. Like, why are people interested in blockchain? So I'd probably say there's a few categories, right? The first category might be why Bitcoin was created in the first place, which is people that are not happy with the current financial system for all sorts of reasons. Maybe they don't trust it, maybe they don't trust the institutions, and they're looking for an alternative. Right? So that's kind of the cyberpunk movement. And there's a lot of people that got into the space and maybe have stayed in the space for that reason, and maybe invested in the space for that reason as well. So a kind of alternative financial system. The second type, I would say, or second reason people get involved is just to turn £1 into £2, right? So just because they see it as an investment, and they're trading or they're speculating with the tokens that are used to run these systems. And so that's obviously pure speculation. The third reason is efficiency, right? Is the technology itself, right? And this is where I come from, and maybe it's a bit naive because maybe I should have gambled a bit like some of the others, right? And then I probably wouldn't be standing here after 10 years still running a company. But the thing that attracted me in the first place to the technology was the technical efficiency, right? I can see through the model that I've just shown you, you can do financial transactions, and in particular more complicated financial transactions, in less steps and with less manual intervention, right? And you can do them with parties that you don't know or trust. And if you look at today's financial system, that's not how it works, right? We pay to have lots of intermediaries look after lots of things for us and make sure things get executed. So it's all very manual, and there are fees being taken along the way at every step, and there are time delays all along the way as well for similar reasons. So for me, efficiency is we can do things quicker, faster, cheaper, and that's true for most technology evolution or revolution. And in the case of blockchain, that's exactly what this is. Right, we can do things quicker, faster, cheaper. Okay, and I'll demonstrate why. But it's very difficult to push this through when you've got all this other noise about the first two sort of crowds of people or reasons that I mentioned earlier, because they drive and incentivize all sorts of other behaviors. Okay, so the reason I think most payments and assets will move on chain is because I think it provides transformative efficiencies for managing and transferring value. Okay? The second statement I'll go into a bit later. I think the more complex the thing that you're trying to do in terms of moving assets and exchanging assets and money, the more complex it is, the greater the efficiency gain from this type of technology. Right? So if I'm just doing a payment and I'm moving a token from my account to one of yours, that's pretty simple. It's not going to make a huge difference on here. Right? But if we're trading, so if you've got an asset that you're transferring to me and I'm paying you at the same time, we can do that on a blockchain very efficiently. And if we want to create more complex structures on chain, which is what we've already been seeing in the public blockchain space, we call this decentralized finance. If you want to do more complex things with money and assets, then the efficiency gains really start to grow almost exponentially. Okay? So that's kind of the first assumption. Just to give you an idea, I won't go into depth about decentralized finance and the more complex things. I'll take you through one example. But where this gets to is exchanges where we can exchange these assets, and all of that running in the blockchain itself, and also lending. So lending and borrowing and interest payments and so on. So the core building blocks of our financial system are already starting to be modeled in a very basic way on these blockchains. Okay, so the first thing is the efficiency increase. The second thing, and this is my personal view, again, it's very different to the first couple of groups that I described. I think the greatest efficiency is available to businesses, right? Because, and it's not what we've seen initially with blockchain, right? Initial users are probably individuals speculating and trading and so on. But I think the biggest users of money and the biggest transfers and the most activity that certainly the financial system serves today is actually to businesses. And so I think that's where that's where the greatest efficiency gain can happen. And when I said we're very early, we haven't really scratched the surface of this, right? But I think that's where a lot of the opportunity will be. And then my next assumption after that is that businesses require commercial privacy, right? So if you take all those efficiency gains that I described earlier and you say, okay, can businesses tap those, right? Can businesses do their payments in this type of environment? Can they maybe borrow and get better rates through this type of environment? Can they get insurance through this type of environment? Can they get more efficient access, more efficient markets, more efficient financial services? Yes, they can. But if it's on one of these ledgers that everybody can see and download, that means everybody will see all their business, right? Now, I don't know, I haven't asked you who you are, but if any of you run a business or work in the financial department of a business, I'm sure you don't want everybody to see all of your balances and transactions, right? No business wants that. And the reason is because as a business, you get your edge from charging customers different amounts and giving them discounts and charging your employees different salaries and your suppliers and negotiating with those and so on. And the more that becomes transparent, the less leverage you have as a business, right? So for that basic reason alone, businesses are going to require commercial privacy, okay? So that's another assumption here, because I'll go through how the space has evolved and how privacy has evolved. But this is where, personally, and I guess from my business perspective, this is where we're coming from. And the final thing I've put here is we have a lot of different blockchains out there. In fact, I've been working in the space for 10 years, and I think literally not a week goes by when someone says to me, have you heard of this blockchain? Right? So I'm amazed by how, by just the number of different blockchains that are out there. For me, it's complete nonsense. It doesn't make any sense, right? I mean, it's nice when there's innovation and there's lots of people trying, but I think the real incentive is the second group that I talked about, which is people that think they can turn ones into twos, £1 into £2, and I think that's created a very strong incentive for people to just create their own. And so we have this huge proliferation. But if I come back to why we're doing this, or where the benefits are in efficiencies. Efficiency isn't having 10,000 different networks, right? Efficiency is consolidating to probably a very small number, if not one overall network, just like we have with the internet, right? The internet is a network that connects everything and everybody and all our devices. From a technical efficiency perspective, blockchain is the same, right? It's an internet of value. So why should we have lots of pockets?
Can I just
right?
say
Yeah,
something?
yeah.
What if different communities want their own blockchains with their own personalities, but now
Yeah.
with cross-chain swaps, atomic swaps, they can
Yeah.
all talk to each other quite efficiently?
Yes.
Maybe that is
So-
where we're heading, or do you think we will eventually consolidate to just a few?
So I think I see the blockchain as like the internet protocol, right? So you can have lots of communities on top, right? But why do they need a separate network and a different technology and a different set of protocols, right? If so, again, if I go back to like this is an engineering talk, right? And the reason I'm interested in this is the engineering efficiencies. If you have two networks and they have different technologies, if I'm transferring between two wallets and we're doing a transaction on one blockchain and we're going through a smart contract, that's super efficient. As soon as I have to now jump to another ledger, I've lost everything. Right? In that hop, I'm effectively going out of the blockchain world. All of my security assumptions are gone. Right? I'm now completely dependent on a bridge. Right? If we talk about where have hacks and compromises happened, it's in those bridges between networks. Because you lose all of the security assumptions of the network itself. So again, from a tech perspective, that's a weakness, and it's an unnecessary one. Right? Maybe from a commercial perspective, there's reasons why we would have multiple. Right? It's maybe why we have different social networks. I don't know. Right? I could also argue like all being on the same network would make more sense. So that's my personal view from an engineering perspective. Doesn't mean it's where it'll go.
Yeah, engineering versus commercial.
Versus commercial, versus social, versus political, whatever. Right? But again, from an engineering perspective, Ethereum seems to be the de facto standard. Right? And Ethereum isn't necessarily just the Ethereum network, it's the Ethereum set of technologies and standards. So we have within Ethereum we have what's called the Ethereum virtual machine, which is where we run smart contracts. There's a smart contract language called Solidity, and then we have these token standards for how different tokens are defined in Solidity, and these are ERC20, ERC721, and so on, which if you're familiar with the space you might know. But these standards have really flourished, right, and really proliferated. And even other competing blockchains, many of them have, and the more successful ones have adopted the Ethereum technologies and standards. So right now we kind of have this spread of different blockchains and different technologies and a lot of competition. And I was talking to someone, I think it was a week or two ago, at one of these conferences, and I said to him, you know, this has got to consolidate, right, for technical efficiency reasons, right? And maybe the standard, as we have on the internet, maybe the standards haven't emerged yet. And this person came with an interesting response. He said, chances are the standard's already there, people just don't know it's a standard yet, right? Or they haven't come to terms with it. And so I think that's probably the case, right? And the other way I would shape this, again, this is kind of looking at it fairly independently, is most of these other blockchains, they've created their own tokens and got lots of funding for that. Most of the applications and transactions that are running on those other blockchains have been paid for by the foundations of those other blockchains, right? Yep.
What does the RPC stand for?
The RPC, I'll explain that in a minute. But I'll just say from an economics perspective, the Ethereum blockchain today runs most of the activity and hosts most of the assets, and is one of the few that doesn't actually pay, or give out lots of grants for the projects to be there. So it's the one that's chosen by most of the projects where they have a choice, an independent choice, right? It's not to say there isn't interesting technology in some of these other chains, right? And some of them might be more advanced than Ethereum in different ways. And Ethereum is also spread out to a layer, different layers, as you know. I'll talk about that a bit later. Okay. I'll talk through an example, just coming back to the efficiency play, right? So let's say I want somebody to build me a website, right? And I go onto the internet and I find a freelancer who builds websites, right? Now, I don't know that freelancer. That freelancer doesn't know me. It gives me a quote. I want to spend some money. Say they want $1,000 to build a website. I'm not going to pay them till it's done, right? They're not going to want. They're going to have to do the work and trust me that I'm going to pay them, right? Now the marketplaces, the platforms have some trust capabilities built into them, but not around the payment itself usually, right? The payment is usually done through card or bank transfer, and it's usually done once the work is done, right? Unless there's a deposit. Yeah? The alternative to this, okay, I'll talk you through it. So the alternative is basically escrow, right? And the example for where we see escrow in today's world is if I come to buy a house, right, and I'm going to pay for that house, whether it's through cash that I have or through money that I'm getting from a lender, I'm not going to transfer that cash straight to the seller, because I want to see the rights and the deed transferred to me, right? And they're not going to transfer the deed to me until they know that I'm good and the cash is there ready to be, that they're going to get the cash, right? So the way we handle those kind of transactions today is we do it through an intermediary, we do it through lawyers. And those lawyers act as, they provide an escrow service. So the cash will be transferred to their bank account, they will hold the bank account, and they'll show the other lawyer on the other side, or the buyer, or the seller, here's the money, it's ready, now transfer the property, right? Now, that's a trust problem, right? And it's solved today in a not very efficient way, because we have to have these intermediaries who are effectively compensating for the fact that we don't trust each other in the transaction. And that's something that we can solve for in a blockchain. Because we have a network where the network shows us who owns the assets, and we have smart contracts where we can define the rules of how those are exchanged, we can actually have an environment where the buyer and seller can interact directly and not worry that they're going to lose their asset or lose their funds, right? Because they have guarantees from the network and from the smart contract of what can happen to their funds and to their assets. So the example I'm going to give is it's a platform that we've actually developed for a client. It's called Portofino, and it's an escrow service for anyone providing services, right? So I gave the example of someone building a website and someone commissioning to do that work. And the way it works is that funds for the payment for the work gets locked in a smart contract, and it's visible to both parties. So the buyer that's buying the services submits the funds into the smart contract, and then there are very clear rules about how those funds can exit the contract, right? So we have mutually predetermined terms for the funds. Payment terms only change if there's a dispute, and I'll explain that in a minute. The buyers and sellers are KYC'd, so at least we have some level of checks to know that this isn't a money laundering scheme. If that's interesting for you, of course. The system itself has, we've designed it, even though blockchain is quite complex, we've designed it to have easy onboarding, so the wallets, the private key management is using biometrics, and it's quite seamless for the users. We use one of these on-off ramps in the background to buy and sell the stable coins. So we actually use Bridge, which is a company that was acquired by Stripe, which I talked about earlier. The payments themselves can be split into milestones, because typically if I'm building a website, I might get the designs and then I'll get an early proof of concept, and so you can have milestone-based payments. And if we don't agree that the work's been done or done satisfactorily, so the buyer doesn't want to pay, but the supplier says, I've done the work, then in the beginning we'll agree, here's a third party that can handle dispute resolution. Each party will both give them the evidence, and they can make a final decision, and they'll have the power to release the funds based on their independent decision. Okay, so the example here is we have a buyer and seller. They agree the terms, they agree the milestones. The buyer moves their funds into the smart contract. The smart contract has transparent rules. It can't do anything else to those funds except what is in the code in those contracts, which is visible and transparent and verifiable. Nothing else can happen to those funds. The seller submits proof that they've completed the milestone. So here's some proof that here's some screenshots from the website, I've done the designs. The buyer looks at those and submits a response, right? Approves the work. When the buyer approves the work, the smart contract releases the funds to the seller. Okay? Very simple. Why is that valuable? Because the seller, when they were commissioned the work in the first place, how do they know that the buyer is even good to pay? Right? I can tell you, as someone who runs a business, I've got customers who still haven't paid us. Right? Oh, now they tell me that they're raising funds. Right? Turns out they forgot to tell me at the beginning. So in the real world, you don't really know. Yep.
You said earlier about like if there was a dispute, a third party would bring it.
Yes.
How do you know a third party would be trustworthy? Is it not possible that either the buyer could have someone to like be for the seller?
Yeah, yeah. So in the contract, both parties agree who the third party is, right? So the third party is another actor here with their own wallet, and both parties have to agree before the buyer puts any money in. They agree who that third party is. In practice, we've got an independent law firm that's attached to this in the first version of it, but you could assign anybody. That's how it would work in principle. So you pre-agree an independent party that both sides are happy with. And the efficiency here is that you only need to engage that third party, so you only incur the cost of having a third party if there's a dispute. Whereas normally with an escrow, you'd need a third party to actually manage the funds. Right? The smart contract, the way I think about it is like an autonomous vehicle. Right? Because it's running on the network, and it can't do anything other than the code that's there, it is acting autonomously. Right? So it's kind of like a self-driving car. Right? And you can draw parallels, arguably safer, definitely more efficient. And so that's really what this is. This is sort of autonomous management of funds. Either the buyer or supplier can raise a dispute. So the buyer might say, this is garbage, I don't accept this work. And in that case, then it goes to a mediator, and the mediator can determine the split. So if $1,000 has been put in the escrow, the mediator might say, well, half the work was done, so it's a 50-50 split. And that's what will happen. I forgot to say at the beginning, once the buyer puts their funds in, they can't unilaterally pull them out. Right? And that's quite important, because as a supplier, I want to know that the money's sitting there and it's going to come to me, and the buyer can't just pull it back. Right? So I know I'm going to get paid unless the mediator determines otherwise if there's a dispute.
Yeah,
Yep.
you have biometrics. So what role the biometrics play? Is it before is it protecting the wallets? Or
Yeah, it's protecting their wallets. So what we do, just for simplicity, we've designed this for people who are not necessarily part of the crypto community or really well versed in crypto wallets. So we've tried to make that quite seamless. So we have a wallet which uses the biometrics. It uses something called passkeys, which are an alternative to passwords. It's been rolled out essentially by Google, Apple, and in most of our devices, and people are using that to log into their services without really thinking about it too much, because it's based on the biometrics of the device. So we create the wallet and secure the wallet using the biometrics, using the passkeys. Yep.
Yeah. Exchanges now don't use biometrics. So is it that is a system you have deployed that is using
What doesn't use biometrics?
Yeah, exchanges.
Exchanges, yeah.
The ones available now, they don't use biometrics. So is it something you have built that's using biometrics now?
Yes. So the exchanges, most of the exchanges are off-chain, as we would say, right? So they're not using blockchain technology, essentially, right? They're using what we call Web 2 technology to provide their services and secure them. So technically, from an engineering perspective, it's a completely different environment. What we're doing is we're linking the biometrics to the passkey, which is something provided by your phone operating system, by your device operating system. So Apple or Google in their operating system are creating those keys. In some cases, they're putting them in a secure enclave in the device. Then the operating system has the biometric check, which gets the key to sign, which then goes straight to the blockchain, which then recognizes the user as that user. Right? there's a bunch of engineering complexities and questions around that as well, like how are keys recovered, how are they transferred. We do allow people to then move to a different type of wallet if that's what they want, but that's the starting point for ease of use. Yeah. So yeah, that's essentially that's Portofino. So that's an escrow escrow application. And the reason I've highlighted that is I think it's a very simple smart contract, but it really shows you just the basic mechanics of what can be done here and how it can be more efficient than if we didn't have a blockchain. Yeah, so it's kind of an illustration of that. Okay, and then I mentioned that businesses need commercial privacy. So again, if I as a business, if I'm engaging contractors to do different things, I don't want all those numbers out there. So we need commercial privacy. So how do we achieve privacy? So when I started the company back in 2015, I came from big businesses, I'd worked for banks and telecoms companies and so on. I went back to them with this blockchain technology, and the first thing they said was, well, we need privacy because whatever we do, we can't have our customer data and our own data out there. So the industry came up with what we call private blockchains. And what private blockchains do is, if public blockchains everything's open and everybody's connected, the first thing private blockchains do is they isolate. So we only have a limited number of nodes on the network. They're run by a specific set of known parties. And worse than that, they're not all holding the same copy of the ledger. So each one has their own version of the ledger. They send transactions to specific other parties, and no one else knows that the transaction, any details of the transaction. So what we end up with is different validators and nodes held by different organizations, and they're all each one has a different ledger.
And they're again relying on that centralized one party again.
There isn't a centralized one party in this,
All right.
but let's say I'm bank A and you're bank B, and he's bank C. So transactions that I'm sending to you and I have in our ledger, but he doesn't have in his. And then if you two are sending a transaction to each other, I don't have that transaction. So we all have different subsets of the overall activity. Effectively, transactions are only sent to and shared with the counterparts to a transaction, right? No one else even knows it happened. Yeah.
Yeah. So in terms of safety, how does centralized and decentralized exchanges come to play? Which one seems better?
So it's going back in terms of the topic a little bit, but decentralized exchanges are on the blockchain. So they're effectively, everything that happens is your wallet talking directly to a smart contract. And you know how I showed here the smart contract handling the escrow? In this case, the smart contract is actually taking your tokens and actually holding pools of different tokens, and the smart contract itself is actually swapping them and then giving you back to your wallet whatever you're buying. So the trade is happening directly between users and their wallets and smart contracts on the blockchain. There's essentially no third party running it, right? And the security of it is the security of the blockchain. So from a purist and an engineering perspective, that's much more secure, right? When you use an off-chain exchange, let's say, I don't know, Binance, Coinbase, whatever, they have wallets that they're holding on people's behalf, right? And so they're buying and selling the assets and bringing them into their wallet as they choose. And then on the other side, they're showing you your balance if they're holding assets on your behalf, and they're taking your payments in the fiat world or paying you back. So it's an off-chain system, right? And so it has all of the security assumptions of, let's say, a regular web application or system or back-end system or whatever, right? So they have to take the same kind of measures as a bank. They have to completely secure their infrastructure, especially the keys, right? Certainly in the early days of blockchain, a lot of the compromises we had were exchanges losing the keys, which meant that all the assets that they were holding for their users were gone, right? So if you're using decentralized finance, you've got the wallet yourself, right? You're not dependent on a third party to hold and secure your assets. But the thing that they're able to do is they're able to do things very cheaply, because sometimes on these blockchains you can be paying fees and waiting for things to happen, and a centralized exchange, because they're not waiting for the blockchain, they'll just do everything internally very quickly, and so they can be cheaper, yeah, and faster, because they're not necessarily really doing the transaction on chain, yeah. So there's a big trade-off. I mean, the big thing that blew up our industry was FTX, right? FTX was exactly that, right? They were supposedly holding all these assets for people in their wallets, and they actually went and did something else with the assets, right? They invested them in something else and lost all the money and so on, right? But as a user, you wouldn't know that, right? Even the investors who should have had access, right? The board, I don't think there was a board and so on, should know that. But that's exactly the difference between a blockchain and not a blockchain. On a blockchain, on your decentralized exchange, you can have a look at the blockchain, you can see your assets, right? No one else can touch them, and you can see that, you've got guarantees about that. You could even download a node and run the contracts yourself alongside everybody else, right? You're not dependent on everybody else, and you've got the security guarantees of the network, yeah? So yeah, I was just saying about private blockchains. This was kind of the first instinct of large institutions and enterprises that started playing with the tech. The thing is, when you do this, when you start having different ledgers and you're only sharing individual transactions, you've no longer got a shared ledger. And so you don't have an asset registry anymore, because like the assets are moving around and nobody has there's no ledger that's got a view of all the transactions. So how do you know what sits where? Right? You'd have to go around all the different nodes and start to trace the thing. So there's no shared view and there's no ledger of asset ownership, right? This gets lost a lot in marketing. We see a lot of companies today with supposedly public blockchains, but actually what they're doing is this. And in the marketing, it looks like they can do all the things that a public blockchain can do, but they can't. And this is where the engineering comes in, because if you really understand what's happening under the bonnet, you can kind of you can appreciate what works, what doesn't, how it works, and where the efficiencies really are. So I think these systems were kind of great for institutions to play with when they first started. It's a great sandbox, but if you want to actually get the kind of efficiencies which are really there, which are going to play out in the financial industry, you can't stay here. You've got to be on a shared ledger.
Can I just give an example?
Yeah.
JP Morgan, they were experimenting with a private blockchain.
Correct.
But just today,
Yes.
they've launched JP Coin on Base.
Yes.
Public layer
Correct.
blockchain.
Correct. That's I know, and I've known about this for a while. It's super interesting. What they did initially was they had these private blockchains. Now, as I said, the private blockchain doesn't really give you much. But if you've ever worked in one of these banks, you would know that the internal infrastructure has been built over many years and is very inefficient. And so sometimes just laying down some new infrastructure, even for your internal transfers, can actually really, really help you to do things. So that's kind of what the first stage was. But the second stage is very interesting because it's now putting their deposit token that represents funds on their deposit onto a public blockchain. And that potentially opens it up to these kind of applications like the escrow one and the swaps, the decentralized exchanges, and so on, right? Subject to probably all sorts of other regulations and so on. So private blockchains, I've talked about, yes, they're private, but also I didn't say this, but every participant has to have a node if they want privacy. No one really wants to host one of those nodes. We ran into that problem quite early. The cost multiplies with the number of participants because the cost of the overall thing goes with the nodes. There's no real shared ledger, and you don't have what we call composability, which means different applications talking to each other, sharing tokens, using the same standard. So you kind of have this plug and play on a public blockchain. One application might create a token, another one might consume it, another one might use it as collateral for lending, and so on. So you can't have composability on a blockchain that isn't a shared ledger, right? Just because there's no shared place to run the composable activity. The public blockchains, they're great, they're secure so far at least. They're transparent. I've put an X because they're transparent is a negative from a business perspective. All the data's public. So this is kind of where the dilemma is, right? Where we kind of, yep.
So how would you audit a blockchain transaction then from a financial perspective if you, in your example of Bank A and Bank B,
Yeah.
let's say you had a public blockchain, for argument's sake,
Yes.
is that all that data available to audit or?
By default, it's all out there in the open. Because I could download one of these Bitcoin or Ethereum, I could download the software. What that would do is it would look for other nodes that are running. It would then download the entire ledger from them. So I could run this, and even if there's software and websites where I can look into those ledgers hosted by other people. But if I don't even trust those, I could download the thing myself and go through and see all the transactions. You'd see all the accounts. You'd see all the transactions that have ever happened in those blockchains since day one.
But in your
Yep.
third example where you have a private
Yep.
network,
Yes.
then presumably you need an auditor with access to those private ledgers.
Correct. The way that would work in practice is either the party that's running the ledger gives the auditor access to their ledger, or the auditor has their own node and the transactions are sent to that node as well. Right.
But you can just have a situation where you just share parts of the information.
Yeah, exactly. That's what that would be. Yep. But I think the fundamental thing is in that model, you don't have a shared ledger. And when you don't have a shared ledger, you don't have an asset registry. And that means you don't have assets, right? And that means you don't have tokens. And if you don't have those things, you can't do all those efficiencies that I talked about, right? It's almost like, the way I sometimes describe it is, I want a car, so I buy a car, but it's got no wheels, because I couldn't have the wheels, so we took the wheels off. So I've got a car without wheels. Everything else is there, right? But it's not going to go anywhere, right? That's what a private blockchain is, right? If you've added privacy, but you've taken away the core fundamental thing that gave it the efficiency. So it's still a blockchain, technically. You could call it that. You can still send transactions, but you're not going to get the benefits. Yeah? It's quite a difficult thing to explain and to get across to people, but it's very important. So then the real engineering problem became, can we validate identical nodes or ledgers, right, and have privacy at the same time, right? So the strength and the security of the blockchain comes from the fact that anybody can host one of these nodes and have all of the transactions, and therefore anybody can independently validate them. But if everybody can independently validate them, that means they can also see them. So can we find a way where they can independently validate them without seeing them?
Yes.
Right? And the answer is, of course, is yes. But it took a few years, right? The first way to do this involves a technology called zero-knowledge proofs, okay, otherwise known as ZKPs. So I'll explain what zero-knowledge proofs are. They're a magical type of cryptography. Going to sort of the basics of how we've used cryptography for probably 30 or 40 years now. I have a private key. I use the private key to encrypt a message. Right, that garbles the message. That goes to the recipient. The recipient is able to decrypt using their key. Right, so we use cryptography everywhere today, across the internet and banking and so on, in order to ensure that data is private in transit. Right? What zero-knowledge proofs do is they allow one party to hold some data and create a cryptographic proof of properties of that data. And then they allow a verifier to come along and check that proof, and that proof will assure them that those properties of that data are correct, but it will reveal nothing else about that data except for those properties. Right? And the classic example we have with some simple maths will be the prover is storing their age, and they want to prove that they're over 18, but they don't want to share don't want to share their age. So they create a zero knowledge proof that proves that they're over 18. The verifier can verify that. They have this cryptographic assurance that the data is above the value of 18, but they don't know what the age is. Right? They can't unpack that. Okay. And just a bit of a sort of general statement here. I think, and I created this a few years ago. Actually, this slide was from a previous, from 6 years ago. But now we're in the world of ChatGPT. We've kind of seen the world moving more towards AI, right? And AI, if you think about it from a tech and engineering perspective, it's built on uncertainty, right? It's taking uncertainty and making it more certain, but it's always guessing. Right? AI in general is approximating, right? Whether you're using machine learning, statistical regression, or neural networks, you're trying to arrive at a most accurate response you can, but it's not absolute, right? It's always approximate, and that's why we have errors, and that's why we have uncertainty, and we have hallucinations and so on. And cryptography in general, I kind of see it as a parallel and countering technology. Because cryptography is the technology of certainty, right? That certainty comes from the maths that's behind it. And so if we have a digital signature, we can be certain, within the parameters of the maths, that the party that has signed this data is the party that holds this key. Or if it's encrypted, we can be assured that it's private, subject to the maths behind it, right? Assuming there's no quantum computer that's broken it or something, right? So I think there's an interesting play between these two. And I think when you start looking at zero knowledge proofs, there's also this idea that you can start having privacy around data and getting more from it, rather than just having to have the data to digest directly. So zero knowledge proofs. So it's trivial to prove that one possesses knowledge of certain information by simply revealing it, of course. The challenge is to prove possession without revealing the information itself. So we have Peggy the prover and Victor the verifier. And so they're going to have interactions between them where Peggy holds a value of X and Victor's going to be assured that Peggy knows X, but he's not going to know what X is. And there's a puzzle here. I don't know if any of you are familiar with this, but this is a sort of nice illustration of how zero knowledge proofs work in a simplification of all the maths that's behind them. And Peggy, who's wearing the purple shirt here, is going into a cave, and that cave splits into two, right? And Victor's outside. He tells Peggy whether to go right or left, but he can't see into the cave, right? So he's randomly telling her go right or left. She goes right or left, and then the other side of the passage of the cave is blocked, and there's a door there, and she's proving that she can get through that door. Right? That she has the key to go through there, that she knows the code, right? And the way she proves that is that Victor, he tells her to go right or left, and she will come out from whichever side he's expecting, the opposite side, right? And that proves to Victor that Peggy has the ability to go through that door without him actually seeing the door or seeing what she's doing or have any knowledge of that, of how the door works. Okay? So that's a kind of illustration of the principles behind it. And so I think this was around, 2008 was Bitcoin. I think Zcash was probably around 2012, something like that. Could be getting my dates a bit wrong. But Zcash was a version of Bitcoin that was built using zero knowledge proofs. Okay? And the idea is that it has validators. Those validators, instead of seeing all the data that they hold and validating it through seeing it, they hold the data encrypted and using zero knowledge proofs, and they're able to validate that the ledger is valid, right, and that the integrity is there without seeing it, okay, without actually seeing the transactions and the balances. And what they're validating for is they're validating that the ledger is working correctly. So people are only sending funds that they actually hold, right? And there's no double spend. There's no same transaction being sent twice, representing the same money. So all these things that give you the integrity, that you can trust the ledger, that it's operating correctly, those things can be validated for by these validators who are holding the encrypted ledger, but those validators can't see the numbers on the ledger. Okay? So functionally, that gave us privacy on the blockchain, right? It worked. It was a big breakthrough. It was the first real use case, I think, for zero-knowledge proofs as well, the first sort of mainstream use case. It's very slow. It's very bespoke. And the other thing, if I think about the use case I'm looking at, which is businesses adopting this is absolute. So it's kind of all or nothing. Your balances and transactions are either visible or everything is dark, right? And everything is dark can also take us to a dark place, right? You talked about the fraud that happened this morning. That was actually done on an open ledger. That's how they got traced. But if that person would have done it here, it would have been much harder to trace, right? So if you make everything completely dark, then it's a bit like the dark web, right? You're inviting your criminals and money launderers and so on, right? So technically that's super interesting, right? But it's not necessarily what we need. Yeah? And I'll extend a little bit. So we have zero-knowledge proofs, which I've described. There are other types of advanced cryptography that a lot of work has gone into and have been experimented with, also to solve the same problem. To solve this problem of how can we have privacy on ledgers that can be independently validated, but while the privacy is maintained. So apart from zero-knowledge proofs, we have something called secure multi-party computation, right? This is another type of cryptographic protocol where different parties hold data, right? Different values, and through the cryptographic scheme, they share some. Again, it's like a piece of cryptography, where you can think of it as like a piece of a puzzle, and when you put these pieces together, then you get some outcome, right? So an example that we actually implemented for a client is, let's say we've got a number of people that are trading something, right? So we did this with ship brokers. Let's say we're trading ships or shipping lanes or whatever it is. And so we're doing transactions every day. And so we know what the prices are in the transactions that we're doing. But we don't want to share the transactions with our counterparts, right? The other people that are trading, because that would be giving away our transactions and all our business information. But we're happy, but what we want is we want to know what's the market price, right? So we don't want to share our transactions. Nobody wants to share their transactions with each other, but they all want to know where's the market at today, right? So what you can do with multi-party computation is everybody runs the algorithm, they get these cryptographic bits, they all share them with each other, everybody puts together all the ones they've received, and they get the price. Okay, so it's worked out, let's say, the average price across all the transactions that were put into the algorithm. So it kind of does a similar thing in a way to zero-knowledge proof, because you can get this outcome without knowing the underlying data, but it works in a different way, right? It's called multi-party computation, because it's different parties with different data sets, and then computation that kind of gives us an outcome that we're happy to share. Yeah? The same technology is also used to secure wallets. So we have types of keys where maybe 3 different parties hold a piece of the key, and none of them know what the other parties are holding, and they can bring them together to create one key using secure multi-party computation. Right? So that's multi-party computation, and the third one, which is more recent, is called fully homomorphic encryption. And this one I think they're all quite special, I think, and quite magical, but fully homomorphic encryption is really interesting. What you do is you encrypt data, and you put it, let's say you put it on a blockchain. So you've encrypted the data that you hold, you put that on the blockchain. The smart contract can hold that encrypted data and can now run calculations on it. So for example, I put the value 5 encrypted into the contract can now do a +1. Right? So the contract doesn't know there's a 5 there, but it's doing a +1, and if I now pull back my value, I'll get 6. Right? But the contract, which means the validators running the contract, don't know what the number is. But they guarantee that the +1 has been applied. Right? So it's effectively applying mathematical operations on encrypted data to get an encrypted outcome. Right? And the party that's executing that isn't aware of and can't understand what the underlying data is. Yeah? So this is another technique that we're seeing more and more in blockchains now, where somebody can have a balance and they hold their balance on chain, and their balance is updated when tokens are transferred, but nobody can see their balance, for example. Right? So these are different techniques. I would say that there's a lot of protocols out there creating solutions around this with any combination of these three. No one's completely cracked it yet. We have different pieces of the puzzle that are solved for. So we already have tokens that can exist on a blockchain using probably any one of these protocols, right? But what can we do with those tokens? It's probably quite limited, right? We can probably just transfer them between each other. We probably couldn't even do the escrow, right? Because any logic that you now want to add to a contract really needs to be baked into the whole privacy scheme and the cryptography of it. Otherwise, it has to be revealed. Yeah. So things are still fairly limited, and most of these protocols they're pretty bespoke. The cryptography is very complex. It's still quite novel, and it's still quite slow. So I think this is how it will eventually get solved, but it's still quite early. Okay, the next thing I'm going to talk about, this is a slightly different topic, layer 2s. So we have these public ledgers like Ethereum and Bitcoin. Ethereum, I keep saying, is particularly interesting because it has these smart contracts where we can run applications and gain all these different efficiencies. But even Ethereum itself is quite slow and at times is quite expensive. And so Ethereum has really created this ecosystem of what we call layer 2s. And the layer 2s are another network that's kind of attached to the main, what we call layer 1 Ethereum blockchain. Okay? And these layer 2s, they have more freedom. And so they can be faster, cheaper. They can be these communities that you described, right? They could optimize for certain use case or certain type of environment. And what they do is, the reason why they're interesting is because they inherit the security properties of the layer 1, right? And what do I mean by that? So let's say I'm putting my assets on layer 2, right? And you're using a decentralized exchange there, okay? So now your assets are there, you can see the decentralized exchange contracts, you can see they're all there, but it's not Ethereum, right? So how do you know this layer 2, who's running it, is it secure, right? The way layer 2s work on Ethereum is if that layer 2 goes down, disappears, is destroyed, you can come along with your wallet and the data of your transactions, post it to layer 1 Ethereum, get your funds. Okay? That's called an escape hatch, and that's a feature of these layer 2s. So the fact that people can recover their assets on the main Ethereum blockchain, but run their activity outside of it, means that we can then have some very fast, very cheap activity here, and users have the assurances of all the assurances of the public network, the public Ethereum mainnet. No, what they're doing, so there's different methods, but I would say the secure method is using zero knowledge proofs, not for privacy, but to prove the state of the layer 2 ledger on layer 1.
And how
So
often does that happen? Sorry.
that's up to the network. So, I mean, some will do hourly, some will do daily, some will do every block. So that can vary. It's a function of cost and performance and so on. Yeah. But that's one use. That's another use of zero knowledge proofs. I post a proof on layer 1, and then if I come along with the data and my keys, then I can validate the proof, or the contract can validate the proof with the original data and say, yes, this proof matches that data, therefore you really own those assets. Here you go. So that's how the claim works. Yeah.
What if you make a transaction on layer 2 and it hasn't been posted to layer 1 yet?
Yeah, then you're toast. Yeah.
That's why
Yeah.
I was talking about caching.
Yeah, so there is a risk there around. I mean, all these things are trade-offs. There's a trade-off there about, you know, what do you treat as finality, right? With the blockchain, is my transaction final when it's confirmed on layer 2, or do I wait for a proof to be posted on layer 1, right? Depends how you look at these things, right? You could treat layer 1 as kind of an insurance policy.
Maybe you
Right.
can actually revert the transaction if it doesn't come out successful from layer 1. Maybe.
But then we're going into hard fault.
Yeah, that gets quite complicated.
Sorry.
Yep.
Check it's,
Okay. So let's keep going. So that's layer 2s. And then, so now I'm going to go to another form of another technology for privacy, which we kind of went through the motions. We played with all those different technologies that I showed you earlier, and we honed in on this one. And this one, it's a bit of a cheat, right? And I'll show you why. But it actually ticks a lot of the boxes right now. So TEs are trusted execution environments. Okay, what's a TE? So most modern chips from Intel, AMD, NVIDIA have inside them what we call a secure enclave. Right? In fact, the mobile phone in your pocket has one of these as well. If you've got an iPhone or an Android, when you use Apple Pay or Google Pay, there's a key that's stored in the chip. It's stored in what we call a secure enclave, which means that Apple or Google, even though they run the operating system, they can't get in to that part of the chip to get the key, even if they wanted to. That's what's released by the biometrics, by the way. And that key is used to sign your Apple Pay or Google Pay transactions, right? So that secure enclave, that the feature of it is it's a part of the chip that the operator can't get to, right? So there's encrypted data can go in, and code will run inside, and there'll be something that comes out, could be encrypted, but the operating system can't access that space. Right? Can't go inside and see what's going on, right? So a lot of people have had a go at cracking these, and actually fairly recently, some researchers managed to attach some physical hardware to the chip, listen to the encrypted data that was going in and out, and try to decipher it even though it's still encrypted, and actually was able to detect patterns and then eventually understand what the data was inside. Yeah, so you have to look at the security assumptions that you need and what's available in different solutions. With the TEs, if someone has physical access to the chip and they can actually go and stick something alongside it, they could potentially get to that data, right? But assuming that's not going to happen, or that's, I don't know, you've got it stored with Azure Cloud or whatever, AWS, and the chances of someone knowing or getting and attaching chips to the chips is fairly low, then you can use this kind of thing. The way it works, and one of the interesting features is you put code inside, right? You deploy your code that you want to be executed inside the enclave, and then you send a message to the manufacturer, right? Intel, AMD, NVIDIA, and that message is signed by a key that they put on the chip, and it signs a hash of the code that you deployed in there, and it has a hash of the operating system that's running there, the latest version of the firmware, and the manufacturer will come back and say, yes, this is one of my chips, it's functioning correctly, it's got the latest firmware, and this is the code that it tells me it's running. Okay? And that's super interesting if you think about it, because it's kind of an environment that's running with privacy, and it's giving the user, who can access that attestation and verify it, proof of what's running inside. Okay. So if I'm putting my, by the way, I think everybody should be using these, right? I think all the services that we use, government, bank, whatever, at the moment they're putting our data in the cloud. They should be putting them inside secure enclaves, right? There's no reason not to, because this gives additional protection from the operating system, the administrators of the operating system, and so on, right? Everybody should be using these. Okay, so we've taken this technology, right? We've developed a product. I'm going to use it as an example of how you can use blockchains and trusted execution environments to give privacy. So we run a layer 2 inside a secure enclave. And what that basically gives us is a blockchain that runs with privacy, right? And what we've done is we've added rules to the code in the enclave that says that if you want to get to data on the blockchain or in a contract that has privacy rules associated with it, then you've got to sign with your key to prove that you can get that data, right? And then within the smart contract, you can define the rules of who can see what. So you could say this balance, only the account holder can see the balance, right? And the way you can think about it is it's a kind of firewall in front of the blockchain. So somebody sends a message that goes to, signs a message with their key to get the balance. It goes to the chain, it goes to the contract. And if they have to prove that they're the message sender, and then they'll be able to see the balance. If they're not, then they won't get it, it'll be rejected. And that's protected by the hardware enclave. And here's an example. It's a technical talk, so I took the liberty. But it's very simple. You can just see we have some smart contract code that only basically checks is the message sender the account holder, and only then will it return the balance. Otherwise, well, it's basically just checking is this the account holder, and if it's not the account holder, then it's returning immediately. And if we wanted to add, I don't know, someone asked about a regulator, you could do the same kind of thing. You can put rules in the contract, who can see what when, right? It could be only when certain thing happens in the flow of the contract, only certain amounts are reached, or whatever that you share with other parties. I've done a comparison here of like different types of solutions, like FHE, ZKP, MPC, and so on, and the properties they all have. And the interesting thing running in an enclave is you get very, very good performance because you're not having to do any of this advanced cryptography, and you get maximum flexibility and compatibility in your smart contracts because they're just standard smart contracts, right? The privacy is provided by this hardware wrapper. So everything else can just be standard. And then just some examples, just aware of time. So one of our customers using this is DHL. It's actually a company acquired by DHL called CryoPDP, and they do healthcare logistics. So they move packages between hospitals and labs. These can be vaccines, organs, things that have to be temperature controlled and really shouldn't be tampered with on the way. And so they have sensors attached to the packages that detect any changes, and the data goes to the blockchain, and that's associated with the patient data. Associated with the patient data because it crosses borders, and so we have to have checks and so on. And so it's very important to be able to move this data between different parties, to have accountability of the data, to have verifiability of it, and also to have the privacy. And so we've implemented this for them. It's been live for 1.5 years now, and they're the largest provider of this type of infrastructure service in Europe. Another more kind of blockchain-y use case is a company called Archax. They were the first UK regulated token exchange. And so we've taken some of their assets and moved them into silent data where they can be transacted privately. And the first asset we've got there, so one of the big UK pension funds and asset managers is Aberdeen. So Aberdeen have a product, a fund, a money market fund, which is basically holds bonds and some low risk assets, and it pays a dividend. It pays it pays out, and so the holders of that fund can now access that in an environment where not everybody can see what they're holding. But this is a regulated system, and Archax are a regulated exchange. So all the sort of regulator access and access that might be needed by the authorities is available. Yeah. I think I'm gonna. Shall I stop there? Okay. Yeah. I mean, there's a whole range of projects that we've done over the years, but I won't go into those. But you're welcome to ask me.
Can we find it on your website?
Find it on the website. One of the most fun ones was this Damien Hirst NFT back in the day. There's a Netflix documentary called WTF NFT. This is one of the 3 projects. It's very, very interesting. I'll stop there. Okay.
Well, thank you very much, Adi. That's well, obviously you could go on for quite a long, quite a long time, and I'm sure we'd all be very interested to hear all that. So yeah, we'll have to just go and find it and read it in the future. And how many years do you think before we should get you back here to give us the update?
Maybe every 5 years, but it goes in spurts. So nothing can happen for 3 years, and then suddenly, I mean, you've seen this in 6 months, boom. So I think at some point it'll reach a tipping point. And 5 years ago, I would have said, you can see the technical efficiencies, but we don't have a payment token that's really widely accepted. Now, in the last 12 months, I think that's changed. So now that we have payment tokens, we can now have other assets. We can do the delivery versus payment, the swaps. There's still a long way to go, I think, but it's moving.
Okay, great. Well, so in the reception after this, you can ask Adi lots more questions. Unfortunately, we haven't got time for Q&A now. I just, on behalf of the IT, I'd just like to present a very small token of our appreciation. I hope it works.
Thank you very much. Thank you.
And before I release you, we do hopefully be able to, can we get back to my, just to let you know what's going on. No Q&A, I'm afraid. There is a CPD certificate available, and there is a notice outside that's can give you a QR code for that. I can't just move on just yet.
Oh, there you go.
Ah, there we go. So upcoming lectures in London. You'll see there's some in Hammersmith, Harrow, and here at Savoy Place. So the lunchtime one's on Friday, and then the big Christmas one we've got on Wednesday, 10th of December. Oh, God, I can't spell Christmas, sorry. And this is all about fusion, and I think that should be really quite good, because we've got the chair of the all-party parliamentary group for fusion coming to speak. So I think that should be really very informative, and there'll probably be some mince pies, just to make it all worthwhile. So thank you very much for that. And just please do leave your feedback on all these channels or whatever you want. We are on LinkedIn as well, I think. But thank you very much. And now if you go back out to the Faraday Centre, there should be some more refreshments for you. Thank you very much.